Welcome to today's episode of our TonAI Crypto Podcast, where we dive into the latest developments in the world of cryptocurrencies and blockchain. I'm Jane, and I'm here with my co-host, Nike. Today's topic is one that has been on the minds of economists, investors, and consumers alike. The Federal Reserve is facing a major decision, and there's no easy answer.
That's right. The Federal Reserve needs to consider both the state of the economy and the stability of the banking system before making their next interest rate decision. On the one hand, the latest inflation and jobs data argue for continued tightening. On the other hand, recent bank turmoil suggests that a pause in tightening would be prudent.
It's a tough call, and there are valid arguments on both sides. The Fed's decision is scheduled to come out later today, and the anticipation is high.
Yes, we'll be eagerly waiting for the release of the FOMC policy statement and the summary of economic projections at 2 p.m. Eastern today, followed by a press conference with Chairman Jerome Powell at 2:30 p.m.
So, what's at stake here?
Well, the Fed's interest rate decision has far-reaching implications for the economy and financial markets. A rate hike could lead to higher borrowing costs, which could slow down economic growth. On the other hand, keeping rates low for too long could lead to inflation and asset bubbles, which could be equally damaging.
But what are the market expectations for this decision?
Traders seem to be coalescing around expectations for a quarter-point increase. According to CME's FedWatch tool, there is an 86.4% chance of the Fed moving its key rate up from 4.75% to 5%, which is up from 73.8% on Tuesday and 54.6% a week ago.
That's interesting. It seems like the market sentiment has shifted towards a rate hike. What about the possibility of a half-point hike?
A month ago, traders saw a 24% chance of a half-point hike, but now they see zero chance of that. It looks like the market is anticipating a more moderate increase.
I see. So, why is there such a strong likelihood of a rate hike despite the recent banking troubles and market turmoil?
The Fed's dilemma is that failing to deliver a rate increase when inflation remains so far above its target might look like it's less determined to bring price increases under control. On the other hand, the problems that have emerged among banks this month are partly due to the Fed's aggressive hikes of the past year. What's more, the worries about banks will almost certainly add to downward pressure on inflation.
So, it seems like the Fed is caught between a rock and a hard place.
Yes, it's a delicate balancing act for the Fed, but market analysts like Poderick Garvey believe that a quarter-point hike is almost fully discounted. Not to deliver would, in fact, be a shock.
So, we've been looking at market expectations for a quarter-point increase, but we wanted to get another perspective. So, we turned to our AI model for its prediction. So, what did the AI say?
Well, our AI model predicts with 95% accuracy that the rate will either remain the same or be reduced. It justifies this position by saying that keeping rates low stimulates the inflow of funds into risky assets.
That's an interesting perspective. It seems like the AI is prioritizing the stability of the market over controlling inflation.
It looks like the AI model is not alone in suggesting that a rate hike could intensify the stress in the financial system. Some well-known sources are making similar arguments.
That's right. According to Capital Economics, the Fed's monetary policy goals could be seen as working against its financial stability goals if it hikes rates just after taking steps to alleviate banking stress. And Goldman Sachs has also weighed in, saying that it would be surprising if policymakers risked undermining their efforts with a rate hike.
It's definitely a delicate balancing act for the Fed. On the one hand, they need to control inflation and maintain a healthy economy. On the other hand, they don't want to destabilize the financial system.
And according to the AI model, a rate hike could compound the conditions that led to the recent bank runs by further lowering the price of bonds owned by regional banks. That would threaten their financial health and could even spark more runs.
Yes, and what makes it especially tricky is that the Fed's own aggressive hiking campaign is partly responsible for the problem. So they have to be especially cautious now.
It's a tough call, but we'll find out soon enough what the Fed decides. Their policy statement and economic projections will be released later today, followed by a press conference with Chairman Jerome Powell.
That's right. And no matter what they decide, it's likely to have a big impact on the financial markets. So stay tuned for our analysis and insights on how to navigate these uncertain times.